Let's get your home loan rate down. We understand how important managing cash flow is for investors. That's why talking to one of our brokers can help you find the best loan options and a better rate. Your Finny loan expert will assess your loan and quickly spot a better option if it's out there. With access to over 70 lenders and a wide range of products, you're sure to get the lowest available rate in the market. Stop worrying about your repayments now and take charge of your financial freedom. Contact a Finny mortgage specialist today on 02 8866 2444 or visit our website at www.finny.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hi, good everyone. How you going? Phil Tarrant. I'm the host of the Smart Property Investment Show. I hope you're well as we gear up for what I hope to be a quieter Christmas and New Year period. Take it easy for a little while. Maybe less podcasts, more margaritas around the pool. That should be the focus for all of us. You can't do property investment all the time. Sometimes you got to take it a bit easy. But that said, and I find that it's when most people get quite active over the break, when they've got a bit of time to themselves, and they'll be sitting on a mower or pushing a mower around or in the garden doing some weeding. They'll normally chuck on a podcast and binge on property investment. So if you're one of them, sorry, my nasally whining voice, get used to it. But the fact that you keep pressing what's next means it's probably of benefit to you. So thanks for tuning in. It's good to know that it's a real privilege from our side to be able to have these conversations with people right across the spectrum of property investment Australia to help shape the way in which you're investing and how you go about doing it. So use this time to recalibrate and maybe reconfigure your investment journey, work out what you're going to do next year, and just don't be one of those people who's going to do something, actually do something about it. And the fact that you're tuning into this is probably a good first step, but make sure you maintain that momentum. Keep at it, keep cracking at it. You don't have to do something every day, but if you sort of chip away at it, you'll find that you'll be able to achieve quite a lot over the space of a year if you maintain some level of focus. But it's not always easy. Hence the reason why a lot of property investors surround themselves with professionals. They help them on their way. No doubt you've all got a property accountant. If you're a property investor and you're doing your own accounting, I'll probably start chatting to an accountant. You probably miss out on a fair bit. A lot of you would be using buyer's agents, property strategists. Hopefully you're using mortgage brokers to shape your finance planners potentially, and the whole gamut of professionals out there. Lean on them. Always question who they're working for. If you're paying them, probably they're working for you. I'd like to think so. Be curious, be inquisitive, and make sure you shape your buying decisions with as much information you can do, and rely on those professionals you trust. They're out there, believe it or not, and fortunate in Australia, and they're growing in numbers every single day. But there's been people at this for a lot longer than just arriving yesterday, and two of them are joining me on the podcast today, Simon Buckingham and Brendan Kelly. Simon's the director of Results Mentoring. You would know this name. Also director at Property Predictions, and Brendan, director Results Mentoring and CEO of Property Predictions. These guys must like each other because they spend a lot of time together, and I think they get really excited talking about property. So today we're going to get stuck into it. I'm going to try and find out, how do you accurately predict the property market in any cycle? These guys tell me through the wizardry of the way they assess stuff and how they're able to interrogate spreadsheets that they've picked the bottom 3 times in a row, and they reckon they're better than some of the economists at the major banks. Well, you know, they're like weather forecasts sometimes. They'll tell you one thing and the opposite happens. So maybe these guys know more than we know, and maybe they know more than the economists at the banks because they seem to get it right, according to their figures. Gentlemen, how you going? It's a nice talk up there.
How are you, Phil? Are you well?
Oh, I'm good, mate. I'm good. So that's Brendan talking right now, so you can get their names right.
Simon, say something.
Hey, Phil, how you doing?
Good to see you guys. And but you have been at this for a while, haven't you?
We have. We've been.
I don't want to age you guys in a negative sense, but what they say, time in the market is just as good as timing the market. You guys certainly had a lot of time in the market.
We have had a lot of time in the market. We have got a lot more grey hair now than we did when we first started. Yeah, it's been a journey. It's been a fun journey. It's been a great journey, but it's definitely been a journey.
Yeah, that's the great thing about an audio podcast, Phil, is that you can't see all the grey hairs.
Yeah, well, they always say you always look for a bit of grey hair if you're looking for experience, right? And
That's right, but we can use our stock image headshots and not give it totally grey.
Don't worry, we'll hide it for as long as possible. It's amazing what you can do with photo editing stuff these days. But we're here to talk about how do you actually predict the market, and that's what property investment is all about. It's what every single Australian talks about when they're around a barbecue or a dinner party, whatever. Like what suburbs going to do what, where people should be spending their money. Now, I'm sort of the person that pays people to tell me what to do rather than trying to work it out myself, and that works for me. It works for a lot of people, and it's pretty good. I know you guys work on that basis as well. But what I was hoping to get today is for those DIY people out there who try and do it themselves, to try and get some of the science and the wizardry of actually predicting the market, because there is some structure to it.
There is.
And you have different methodologies and different ways you're doing it. So I'm going to try and extract that info from you. Actually, how do you predict trends? Number one. Then two, what do you do about it? Now, that can be at a state level, but importantly at a suburb level. So what should you be looking for? But let's start at the top end, gents. I'm familiar with results mentoring. You guys have been around for quite some time, but property predictions is the name on the tin what it does, I imagine, Brendan?
Yeah, you've got it. Property Predictions is a company that proprietary limited entity began about 2015. But there's some work being done in the background with it. And we've been monitoring statistics on suburbs for many years and applying, and the statistics available to us are free. We're able to look at those statistics and analyze. And we've investigated, and we've investigated, and we've been able to see patterns of behaviour. And based on those patterns of behaviour, we've been able to go, oh, okay, maybe there's a capacity to forecast based on those patterns of behaviour. If those patterns of behaviour are consistent, multiple suburbs over a long period of time, you'll be able to see, okay, well, when are we trending into those patterns? If we monitor the bits, the various statistics that lead into the patterns of behaviour that depict the market, then if you monitor those statistics, you can see where you're heading towards that particular type of market.
It is a real science, isn't it, Brendan? I mean, this is not black magic or sorcery or crystal ball gazing. There's real maths and science behind this, isn't there?
Well, there is, but it's also, you've got to recognise too that we're talking shorter term periods as opposed to longer term periods. When you start to talk about long-term forecasting, you're into the macroeconomics, you're into the population growths and the interest rates and that sort of stuff, and where the macro longer-term trends are, et cetera, and infrastructure spend. But when you're talking shorter-term forecasts, then you get into, statistical analysis becomes critical, let alone the sentiment and the broader economy.
No, well, it's just got me thinking, this is all open source intelligence, right? All this information is available to everyone.
That's correct.
There's nothing proprietary here, right?
Correct.
What is proprietary, and this is the key is how you choose to use that open source information
Correct.
to make determinations or to give you indicators of what you should be doing about it. So this is available to everyone. You might not know it's available, but it is available. You got to work out where it is and how to get it. That's sometimes a challenge. Sometimes you got to pay for it, right? But it is all available. But then, you get all this stuff, you got to put it somewhere. You got to put it into a big cauldron and stir it up and look inside it, and it's going to tell you certain things. But
it takes time to gather that much, correct?
Yeah, it does. If you don't know what you're looking for, you're not going to find it. So this is, again, one of these sort of unknown unknowns. And I think the best property predictors I know are open to finding the unknowns, but have the capabilities to search for them, even though they might not be necessarily looking for them.
Well, the thing is, you're not always right. The first time you have a crack at this stuff, you go, oh, look at that. And then you expand on that and you look at things and you look deeper and you go, nah.
No, so not going to happen.
It's like the Edison and the light bulb. It is a case of you have a crack and you get it wrong, you have a crack, and then you see consistencies. And it's when you get those consistencies that you can go, oh, there's some relationships there that tend to hold true. Mm. And those ones you can tend to rely on. And then you monitor the trends of those, and that leads into the future.
Yeah. So the question I've got then, and it's interpretation of information is what you're doing and how you choose to act on it. So all this information is available to everyone. And there's a sort of glib comment that, you guys seem to be getting it better right than some of the big banks, economic forecasters. But why do you think they get it wrong? Because, I think back to even COVID, many of the major banks were telling us of 30 to 40% decreases in property, which people acted on, by the way.
Yeah.
So why do you feel as though you're getting it right when other people are getting it wrong? Maybe that's a question for you, Simon.
Yeah, the main problem is that the big banks and most economists, and frankly, most of the media and most property investors get it wrong because they focus on the wrong information. They focus on the wrong drivers, the wrong indicators of the property market. And I think many of them fail to understand some basic truths about how the property market actually works, which Brendan, I think we'll go into a little bit today in terms of how you read the market. That some of the key issues are when they come out and they make a statement like property prices are going to fall by 40% or 20% or boom by 10% or whatever, they're treating Australia as if it's one single property market. So they're trying to apply this big macro approach that assumes that all ships rise on the rising tide or fall together. And that's not the reality. The Australian property market is not a single market. So in taking this sort of top-down approach, they look at, interest rates are going up, or there's a pandemic, or Labor's talking about abolishing negative gearing, so prices must fall. And that ignores a real fundamental that the market is not one market that all moves together. It, in fact, is a collection of markets and not just a few markets at that. So, when we've gone out there and you mentioned before, Phil, that we've said we've been able to pick the last 3 dips in the so-called cycle of the property market. The reason we've been able to do that is because we're actually taking a very different approach to the analysis than most commentators, most forecasts, and certainly the big banks. I think there's a running joke inside many of the big banks that their property market forecasts are consistent in one way, and that's that they're consistently wrong. What we've been able to do is stand in front of groups of people, and we've been videoed doing it, calling the bottom of the market. I think in May 2019, around the time of the election, we stood up in front of 200 people in a crowded room and rang a little bell calling the bottom of the market. And people came up to us afterwards and said, "How can you be so confident?" It's because we do see the market differently. The reason we've been able to identify those sort of turning points and predict market movements is that we don't take a top-down approach in our analysis. We take very much a bottom-up approach. We get right down into the granular detail, and we've recognized that the Australian property market is a collection of many markets. I mean, Brendan, how many suburbs and towns are there in this country?
More than 15,250 suburbs, and growing and changing all the time. And the boundaries of each change with some regularity. And within those suburbs, there's about 5,000 plus suburbs that are unit markets. So you've got 20-odd thousand individual property markets, because housing markets and unit markets don't play the same. And suburbs, neighbouring suburbs, even within the same postcode, don't play the same either. So no 2 suburbs are behaving the same way at the same time. So, you got about 20,000 individual property markets playing out.
Yeah, so the first thing you got to take from that, Phil, is that when someone says that property values are going to move up, down, or sideways, they're going to crash, they're going to boom, the question is, well, where? In which market? Or which markets? Because if you're saying that Australian property values are going to go up, you're aggregating over 20,000 discrete property markets to come to that conclusion. Whereas if you really want to understand the market, you need to be understanding it right down at that individual suburb level, looking at the trends within each suburb, and then starting to aggregate and combine those trends to see what's the city going to do, or a region or a state or the country as a whole in aggregate. The problem with the big banks and the economists is that they don't do that. They make assumptions about what drives the market from a top-down perspective, with ignoring the actual trends that are going on down below. And it's a very different approach to what we call property market dynamics. And it's those dynamics that really drive property price behavior in Australia. And it makes once you start to understand that, it makes a massive difference to how you choose where to invest, decisions you make about where you already hold property, because you have far greater clarity about what's really going on in that specific market as opposed to the noise of the media that's telling you, one day that property prices are going to fall by 20 or 40%. And then 2 months later is telling you that property prices are forecast to go up by 10 or 20% over the next 12 months. So how can you make any kind of informed decision with that sort of input? You have to be able to see beyond that. And that was the purpose in, I guess, building property predictions, was to really understand what is truly going on in terms of property market dynamics, those trends at the individual suburb level, and what that's really going to mean for property price behavior from the suburb level upwards. And it's actually the broad concepts here, whilst there's a lot of math and algorithms and analysis that goes on in the background, the broad concepts are actually very basic. And for some reason, economists who should know better completely overlook them, don't they, Brendan? I mean, when we talk about property market dynamics, what is it that really drives property price behavior in Australia, Brendan?
Well, before we get into that, I'm going to just throw a different perspective, a slight varying perspective on that for Phil and the question he asked, which is why do banks get it so wrong? My read on that is that you've got to look at where the bank economists come from. They study economics. They're employed for the purpose of their brilliance around economics and broader economics. And broader economics is a conversation around global relationships, around local relationships. It's around baskets of goods. It's around a whole pile of different things that are not necessarily housing specific. And then they attempt to fit housing into that modelling. And housing plays out very, very different to the business modelling. If you focus your attention on understanding business economics and then try and apply that to the housing market, there's a flaw in the approach. Now, I'd like to suggest that the fundamental difference that Simon and I have with respect to being able to read the market is because we haven't come from an economics trained background. We have lived our lives in property. We understand property. We know how it works, and we relate all economic data to impact on property. So our thinking is significantly different. And as a consequence of that thinking, we look for and listen to data differently, information differently. You're not investing in a vacuum. You can look at an individual suburb and look at the statistics in individual suburb, and you can get a forecast in the short term about what's happening with that without any real difficulty. And we'll talk about that later. But if you want to take macro trends, then you've got to combine that data, as Simon suggested. But you've got to take into consideration the broader economic influences to the property market, not to the broader economy, just to the property market. And you take influences at a higher level and you apply them also to the property market. But it takes a property mind or a property thinker to be able to listen to the right data. Now, I'd like to suggest, Phil, your endeavors over time into property has you read your information and your economic reports and the stuff you research very, very differently than how a bank paid economist would read it. Would that be fair?
Well, it would be fair. And this is not beat up your bank economist day.
No, it's not. It's not.
We're very, very conscious and considerate of the great work that our economists do at the major banks. But the point is that they look at it through a certain lens.
Correct.
You view it through a different sort of lens. It's all the same information. It's just how you choose to look at it with a view towards the outcome that you want. Now,
the filters that you individually apply to the data based on the outcome that you're after, correct?
Yeah, and you can look at this as a property investment. We've got a favourable audience of property investors here. You can either see the opportunities in all of this, 20-odd thousand markets, and go, wow, there's got to be at least one of them which is doing the right thing. But you can get hugely depressed about it and go, there's 20,000 choices. How am I going to choose one of them? This is going to be impossible. So what do? Just get a dart and throw it at the wall, which a lot of property investors do, right? So this is the challenge that all investors face. But if you embrace the right mindset and philosophy in relation to getting the outcomes that you want, and that's finding properties that should be going up in value and hopefully not costing you too much to hold in very simple terms, that's what you got to get right. So the question is for you guys, and Simon alluded to it very quickly, how do you go about it? What techniques are there to try and read suburb at a suburb level about making predictions where you should be investing? So timing to buy or sell, or maybe suburbs to avoid altogether, because there's 20,000 of them. Well, houses and units at an aggregate level. So let's get into that. We'll just go to a quick break. Stay with us, everyone, because I know you're going to want to know how to do this. We'll be back in a moment. And welcome back, Phil Tarrant from Smart Property Investment with Simon Buckingham and Brendan Kelly, the guys, the crew over at Results Mentoring and Property Prediction. We're talking about how to predict property markets at the moment and try not to stick your head in the sand and go, it's all too hard. You got to take action in some capacity, and you got to make sure you collect the right type of information in order to make those decisions. So, Brendan, a question for you is that what are some techniques? Have you got any insights and some techniques to read at a suburb level, the property markets, and at least get an indication or bearing of where not to invest? Because if you've got to get through 20-odd thousand markets, you've got to get down to something which is meaningful. So where do you start at the top of this sort of inverted pyramid?
Sure, great. So you've already got to have a short list of suburbs you're interested in. And if you try and do this individually, one at a time around the country and figure out which one's going to be the best to go into, you're there for a good year, I'd say. So let's not do that. Let's figure out where it is we kind of want to invest broadly first, and how much we're going to spend on whatever we want, whether it's houses or units. And based on the amount of money we've got, and we've done the work on the background of that, and we know our borrowing capacity, we know our cash, we know we can buy, let's say. Then you start to look into the suburbs. Cool. Based on an understanding of the suburb, you can get an idea very quickly around whether or not this is a suburb you want to play in for the short term. For the longer term investor, there are kind of three components you need to consider, but let's go the short term modeling first. Short term is what I want to do is buy something that's got a lift in value relatively quickly, not something that's going to go down in value because that's going to scare me and it's going to make me feel miserable about my investment. What I want to do is go in where there's something that's a lift. Just like every other commodity, it's a relationship between supply and demand. Housing is just the forces of supply and demand. If you don't have a lot of supply and you have a lot of demand, price goes up. If you have not a lot of demand and a lot of supply, price will go down. So we need to calculate or need to have a look at both listings, or four things, listings, sales, median price. And then if you wanted to, clearance rates. Have a look at the listings. So let's say you picked a suburb, call it, I don't know, St. John's Park as an example, Western New South Wales. Why not? If you have a look at St. John's Park and you have a look at listings, you go into realestate.com.au. Why? Because it's generally the most favoured site to go into. You look at, type in your search and search for St. John's Park, New South Wales. Having a look at St. John's Park, New South Wales, and press search. Now, there's an option on realestate.com.au that says including surrounding suburbs. You don't want to select that. You just want to look at the suburb unto itself. You press search and then you've got filter options. What you want to do, I'm after houses. So you look at and select only property type, house or townhouse, because house and townhouse are similarly priced and they represent a similar type of market, the housing market, rather than the unit market. So you select houses and townhouses, you're looking in St. John's Park only, and you press search. And at the top of the list will be a statement that says 1 to 25 of 75 or 1 to 10 of 10. You know, you get a total number of listings. St. John's Park has about 5 right now. So if you go into this, so what you do then is write that down. 5. That's my listings. So if you go to propertyvalue.com.au or smartpropertyinvestment.com.au, or you go to propertyvalue.com.au, you'll see in their suburb search options the ability to determine the number of properties sold. You might need to do some investigation on those sites, but it's there and it's easily to obtain. And it's suburb level. You don't want multiple suburbs, you just want that suburb. And it's broken down into houses and units. We're after houses. So if we have a look then at, for example, St. John's Park, as I have a quick scan of that, we are at, I think it is in the last 12 months, about 45. We're about 45 sales. You go, okay, good. So listed on the property right now is 5 properties for sale. Sold in the last 12 months is 45 properties. So we have a ratio then of 1 to 9. Now, you would think that's actually, there's a disconnect there. We're only looking at properties on the market right now, but you're looking at a year's worth of sales. How can you do that? There's a chronology problem. I'm saying, yes, there is. However, what we've discovered over the years and over the investigation, thousands of suburbs, thousands of months, or hundreds of months, we find that there is a relationship that's reliable that exists between what's on the market today and what's been sold over the last 12 months.
Yeah, what we're looking at there is the listings representing the supply or the stock available for sale in the market today, and the last 12 months sales behavior, if you like, as an indicator or a proxy for demand. What has the demand been leading up to over the last 12 months?
So if we then monitor that, and at a snapshot in time, you go, well, that's great. It seems a lot. It seems a ratio of listings 1, sales 9, that there's a bit of demand there, and they'd be right. And then you go into, well, what does that mean? It's a snapshot in time. You're not sure what it means. So we have a look at median price. Now, if we have a look at the history of number of sales, you'll see number of sales in St. John's Park is rising right now. There is no reliable history of number of listings month in, month out. So you'll need to monitor that and create your own trend from that. So you might need to do this for a couple of months before you get a real consciousness around where market's heading. And typically 3 to 6 months should cover it. If you've got a decline in the number of listings as a trend and an increase in the number of sales as a trend, it demonstrates you've got a growing demand and a declining supply. If you've got a growing demand and a declining supply, it implies that prices have got nowhere to go but up. So what you want to do then is monitor also median price. So you have a look at the median price. And again, if you go to smartpropertyinvestment.com.au, if you go or propertyvalue.com.au, and you look at the graphs of median price over the last 12 months, you might find that St. John's Park has actually trended backwards. So what we've got in St. John's Park right now is a broad declining value of median price. We've got an increase in the number of sales and a decline in the number of listings. By implication, St. John's Park is about to take off. If you've got things are appearing cheaper to people, now this is where the relationship comes into what will happen. Dogs don't buy property, people buy property, and people don't buy property without emotion. So our role is to understand people in alignment with statistics as well. So people will see median prices are starting to come down. They will see number of sales is looking to go up, and they will see and notice when they're on the ground there that the amount of stock on the market's pretty tight. Competition will be tight, and people will start to drive into that. Demand is increasing. So St. John's Park, as an idea right now, is likely to take off in the not too distant future. So if we monitor listings in any suburb that you're interested in, and we do so 3 to 6 months, we'll see a trend. If we look at the sales and monitor the sales over a period of time, you'll also see trend, and you've also got the history of trend on the websites. And if you look at median price, you'll also see trend. If you see an environment where listings are increasing and you see an environment in the same suburb where the number of sales are declining, and you see median price in growth. Yeah, we've got growth in median price. That's the lag that's occurring off the movement. We've had a growth in median price, but we've got an increase in the number of listings and a decrease in the number of sales. Prices can do nothing but go down. There is no opportunity. The pressure is off. The competition has evaporated, and the future of prices in that suburb will decline. Now, obviously, we're talking 6 different options here. We've got listings going up, listings going down, sales going up, sales going down, median price going up, median price going down. And there are shades of grey to all of that. Your objective is over a period of 3 to 6 months, monitor that. So don't be in a rush to buy. Oh, I've got money. It's burning a hole in my pocket. I better get in now and not do the investigation in the suburb, because that could cost you.
And you made a very good point there, I think, Brendan, that people tend to be price focused. They look at what's the trend in the median price, or prices are going up in this area. Therefore, prices must continue to go up in this area. Therefore, I better get in now before it becomes even more expensive. But without understanding those dynamics that you've just gone through, the supply and demand trends, they could make a terrible error, buy in, pay too much, and then see prices stagnate or even decline. Or if they're looking purely at median price and median price is steady or even coming off slightly, they might miss the opportunity and the ability to get in ahead of the wave of growth.
So 2 observations. Number 1, everyone's probably going to go and look at St. John's Park now.
Now, if everybody rushes into there and goes and buys up the 5 properties on the market, of course it's going to go up in value. So
you've probably just done more for St. John's Park than any other local initiative to try and increase property prices. But number 2,
yeah, but you're going to need what, $980,000 to be able to get in approximately.
Median price for Sydney, right? Like it's middle of the road.
That's not that hard for
the other point is that sounds like a lot of work.
But it's not. How is that a lot of work? I mean, if you had to do that for every suburb in Australia simultaneously, yes, that's a lot of work. Yeah. But if you have to do it for 1 suburb, 2 suburb, or even 3 suburbs, it's only a 5-minute exercise.
So it's all about you can't do it, to your point, you can't do it with every suburb. So you've got to really narrow down your search before you go all in.
Correct. This is only valuable for shortlisted suburbs. Correct. You've got to do, what can I afford? Where can I go? What the price am I going to buy at? Look in suburbs with the right median price that's going to serve your needs. Unit market, housing market. You don't want to look at housing market data if you're looking for a unit. You don't want to look at unit market data if you're looking for a house. But once you've got the suburbs shortlisted, say 3, 4, or 5 suburbs that you're interested in, it is literally a 5-minute exercise. It is not that intense at all.
Yeah, I guess it's probably one of those things also is that if you get the logic right and you start doing it, your speed of getting an effective outcome will increase over time. The learning effects will be rapid once you actually understand what buttons to press, and the methodology essentially is what I'm talking about, is going to give you much more sort of scale efficiency, so you can do that. So it's not too onerous. Because I tell you what, I look at real estate. A lot of people say I love looking at property. I don't really like looking at property. I get fatigued with it really quickly. I look at it. I can't be bothered. Don't worry about it. I'll get someone else to do it for me.
Until you're genuinely interested in buying and you're after a specific property type, then sure, by all means, you look for it, and it has a different flavour than what I call real estate porn.
Yeah, which essentially is, and probably the habit of many Australians is looking at property on real estate when they're sitting there watching TV. I know a lot of people do that. Yep. But that was really good insights, Brendan, for how you go about that process of identifying the sort of suburbs that you want to start looking at, interrogating even further, and then sort of what you need to do in order to give the trend so you can make an informed decision. I just want to chat a little bit more about that. We'll just got another break. Stay with us. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment Chat with Simon and Brendan over at Results Mentor. Are you guys more results mentoring or property predictions, or more property predictions, results mentoring? Or is it one and the same, Simon? It's sort of interconnected. One thing feeds the other, I imagine.
They are strongly related these days. We started mentoring property investors before we really built up the property predictions analysis organization. So we're probably more focused on the mentoring side of things on a day-to-day basis, but the ability to read and anticipate market movements obviously plays in really well to helping people make more informed decisions about their investing as part of what we do in the mentoring. So there is a very strong relationship there.
So how does the mentoring, I probably should have asked you this. I've never really inquired before. I thought I've just assumed it. But so how does the mentoring side of things work? Like, give me a sense for how you work with people and what you do.
Yeah, sure. So we run a mentoring program. We take a limited number of people on board every 6 to 12 months, and we work very closely one-on-one with them, understanding what is it that they're trying to achieve through their property investing. So, they're just starting out. Are they an experienced investor? Are they a very advanced investor? Are they looking to just make some smarter decisions? Are they looking to escape the rat race, break free of their job, and using property as the mechanism to do that? And with an understanding of those objectives, we work with them to help skill them up in strategies that are going to support their progress towards those goals, be it understanding the market, doing buy and hold type investing, doing positive cash flow, doing active strategies like renovations, developments, even commercial property and the like. Because our team has a background and we're active investors in the market ourselves on a day-to-day basis, we bring that market knowledge, that real world up-to-date experience to bear to help people become more confident, more skilled investors themselves in a community of other like-minded, very focused investors who are achieving some frankly very impressive things. We've had dozens and dozens of people essentially use property to replace their income from their job and become fully financially independent, which has been really exciting. And we see some pretty amazing examples, people making, 5, 6, even 7-figure profits from their property investments, which is a real thrill for us to see. So being able to be part of that and support people on that journey and assist them with education, with networking, with contacts, with research from the likes of what we can do in predictions, and that direct, detailed support with what they're doing. There's been a lot of fun for us, but it's been really awesome just to see the difference that's made in people's lives and the impact that's had. So that's something we got a real passion for and that we do through our mentoring programs.
So rather than, hey, I want to be a property investor, go and find me a property, you're looking at it through a different angle, and that is we will teach you really creating the resilience and the self-sufficiency of being a functional and capable property investor yourself. This analogy of horse the water and getting a drink and all that sort of stuff.
Exactly right. And helping people build their skills so that they've got repeatable, sustainable and scalable strategies that they can apply to take themselves wherever they want to go, really, with their property investing for as long as they want to do it.
So you'd need to be fully committed then for this to be effective. Like if you don't put the work in, it's like anything, you're not put the work in, you're not going to get the outcome you want.
Yeah, if you sit back expecting that the universe is just going to provide without you taking action, then of course it's not going to happen. It's just a pipe dream or a wish. But if you're prepared to take action and apply yourself to this sort of information, you can make a massive difference to your investing and to your lifestyle and your financial goals. And we've seen that time and time again over the 2 decades now that we've been doing the mentoring program. So yes, you need to be a little bit of a self-starter, but you don't need to have all the knowledge or all the money in the world or anything like that. We basically adapt the program to the individual. And as a result, we see a very personalized and very significant impact that the program has on people.
And no doubt the community itself is something that resonates with other property investors, being able to speak to other property investors without really any bias or agenda other than, hey, we're all trying to achieve the same thing. Whereas I know some people don't want to do that with their peer group because they're worried about, I don't want them to think I'm wealthy. I don't want them to think I'm being uppity because I've got all this property.
Yeah, exactly. And I think we've all sort of experienced that in our circles over the years, that there is a different mindset here, and the ability to connect with like-minded property investors in that sort of community. It's a culture we've created by design in the program, and you really are surrounded by very active, focused people who are out there taking action, who are not afraid to talk about property investing and wealth and money. They don't hold their deals close to their chest because they're afraid someone's going to come along and steal their opportunities. They're very open about it because they recognize that now there is an abundance of wealth out there. There's enough to go around for everybody. So why not share and why not enjoy the journey together?
Yeah, peer-to-peer learning is key, and it's nice to do something if you're doing it, in line with or parallel with other people for sharing that journey and, what doesn't work and what works and how. And no doubt you probably find people that join results who become quite sort of vocal and visible as their skill sets, their capabilities grow and evolve. And in some ways and I know a lot of property investors and, a lot of people go, what's your hobby? They go, I like fishing. You say, some property investors, I'm a property investor. And that's what they like doing, is how they like to spend their pastime. The difference is that the upside of effective property investing is that it gives you optionality further down a pathway when you try and or look to realize the hard work that you've put in. That makes property investing all the worthwhile. But you provide a lot of information. You've been very open in the methodologies, Brendan, in how you go about assessing suburbs and how you actually use some of that knowledge and those capabilities inside your predictions business. But you make this available as well. People can sort of connect with you guys and absorb all this information. You're not hiding the information from people. You're saying, here it is, it's all here, and we'll show you actually how to use it. You've got, and I've seen some of your reports over the years, they're pretty good. You're just about to release a new report, Simon, is that correct?
Yeah, so people listening to this may have seen some of the free reports that we put out through Smart Property Investment and other channels over the years, and they basically identify, or they include some of our latest predictions on suburbs that our analysis indicates have got strong potential to really see great growth in median prices in the near term, sort of 12 to 24 month plus horizons. And at its core, a lot of what we talked about today is in the background of that, obviously supplemented with other data points and methodologies. But just to give you an indication, we sat down and did some analysis the other day of the reports that we'd released back since 2020. Remember when everyone was saying it was all doom and gloom in the property market? Well, we were putting out reports going, well, here's a bunch of suburbs that are set to defy the downturn. Here are suburbs that our analysis shows are likely to go up significantly in value over the coming months. And what we've seen out of the 87 suburbs that were identified in the reports that we released between the start of 2020 and mid last year, that 86 of those 87 have already gone up in value. And the average growth in the median price in those suburbs has been in the order of 35%, and some really exceptional outcomes as well. I mean, we had, if I go back to January 2020, and the report that we released back then, it had, I think, 10 suburbs identified in it. And Carringba South, for instance, in that, had a median price back then of around about the $1.4 million range. That has had climbed by mid this year to over $2.2 million. That's a 50% increase and over $700,000 increase in the median value of that suburb alone. A cheapie suburb that we identified there was Millicent in South Australia. That's actually almost doubled in value over that period of time. So it's like a 97% increase by our calculation since we released the report up till the middle of this year, which is some of the latest median price data available. So really exciting to see that, and a real testament to the fact that this stuff works. This kind of analysis, this understanding of those supply and demand dynamics at the individual suburb level can make a real difference to your confidence in being able to invest. And so, we like to put that information out there. And we have just released a brand new report, Brennan, haven't we, with 11 suburbs, I believe, that we are forecasting are likely to see strong growth over the coming 12 plus months. We're making that available free for anyone who's interested. If you would like to grab yourself a copy of that, just head over to our website, resultsmentoring.com/boom, and you'll be able to pick up that free suburb report and get some of our latest analysis, which builds upon the kinds of things that we've gone through today.
Well, that's very nice of you, Simon, to make that available. Sounds pretty good. So was it resultsmentoring.com/boom? Pretty easy to remember.
Yep.
I'm sure if you just get to the website or Google Results Mentoring, you'll be able to find it as well. But thanks for those insights, gents. It's logical, but it takes time, energy, and effort and many years of experience to be able to work out the best way to go about doing it. So the fact that you're open to and providing that information to other people is key, and hopefully people can make more informed decisions around it. Brendan Kelly, Simon Buckingham, Results Mentoring, thanks for your time today.
Always a pleasure, Phil.
Thank you very much.
Nice one. Hope you enjoyed that. Everyone, remember to go and check out that report. I'll be downloading it myself as I spend time over Chrissy trying to work out what I'm going to be doing next. At least try and filter out some of the places where I shouldn't be investing, and maybe identify some of those areas where I should be taking a little bit more interest. Remember to check out smartpropertyinvestment.com.au, social media, Smart Property HQ. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Do you need help planning your next event? With over 15 years of experience, Captivate Events is the expert in event planning. Our dedicated team ensures every detail is meticulously handled. Whether it's a gala dinner, exhibition, conference, or study tour, we've got you covered. We'll be there every step of the way, from conceptualisation to flawless execution, to ensure your event is a seamless experience, minimising the time and stress involved in planning. Make your next event one to remember. Visit www.captivateevents.com.au or call 02 88 66 2440 and find out how we can captivate your audience.